Most Americans feel the tax system is rigged against them. And when you look closely at the numbers, that feeling becomes less of an opinion and more of a measured observation backed by decades of structural design. The U.S. tax code treats wealth and work as two entirely different realities, and the gap between them is the space where billionaires build their empires. Not through illegal actions, not through hidden offshore secrets, but through rules written in plain sight. Rules shaped slowly, quietly, and with an influence that only grows as fortunes grow. The truth that shocks most people is not that billionaires avoid taxes. It's that the system makes it effortless for them to do so because it rewards those who own wealth and penalizes those who earn it. The most important truth to understand is that billionaires do not make money the way ordinary Americans do. The average worker earns wages. Wages are taxed aggressively the moment they are paid. Every hour someone works has a direct tax cost attached to it. Billionaires, on the other hand, earn wealth through assets, stocks, companies, equity positions, real estate portfolios, and business ownership. None of that is taxed as it grows. A billionaire's wealth can increase by hundreds of millions or even billions of dollars in a single year without triggering a tax bill because nothing has been sold. This is the foundational flaw or the foundational design, depending on perspective, of the American tax structure. It rewards asset appreciation and punishes wage-based income. You can watch this play out in the lives of the richest people in the country. Jeff Bezos' salary is around $80,000, far less than millions of workers across the country. Elon Musk has taken multiple years with a declared salary of zero. Mark Zuckerberg famously took a $1 salary. Warren Buffett has argued publicly that his tax rate is lower than that of his secretary. And yet their wealth grows by billions because almost all of it sits in stock. When Amazon stock rises, Bezos gets richer. When Tesla stock surges, Musk's wealth jumps. But until they sell shares, none of that newly created wealth is taxed. This is not a side effect. It is the heart of the billionaire tax loop. This is where the system becomes even more clever. If an ordinary person wants to spend money, they must earn it and pay taxes on it. If a billionaire wants money to spend, they do not sell assets, they borrow against them. Borrowing does not count as taxable income. Banks are willing to lend billions at extremely low interest rates because these borrowers have enormous collateral and almost no risk of default. A billionaire can borrow $200 million at 2% interest and use it to buy mansions, jets, companies, art collections, or anything else. They repay the loan later using more borrowed funds or through strategic asset management, all while never triggering a taxable event. This borrow, don't sell method is the engine of the billionaire lifestyle. This strategy works only because wealth provides leverage. A middle-class worker cannot borrow against future wages the way billionaires borrow against future appreciation. Banks do not issue giant loans to people whose income is tied to labor. But billionaires can borrow endlessly because their assets continually rise in value. While workers pay tax on every dollar earned, billionaires live tax-free on borrowed money, repay loans when convenient, and continue accumulating untaxed wealth behind the scenes. It is a cycle designed with mathematical precision. The billionaire tax loop doesn't end there. It extends into the way companies are structured. Billionaires rarely own companies directly. They own them through holding companies, trusts, private partnerships, and specialized entities designed to minimize taxable events. For example, in private equity, partners classify their income as carried interest, allowing them to pay dramatically lower tax rates than most Americans earning far less. This system treats billionaire income as investment growth rather than labor, protecting it from high tax brackets. This distinction is one of the most controversial parts of the tax code, but it remains intact after decades because of political influence. Real estate adds another dimension to the loop. Billionaires use depreciation deductions to reduce taxable income even when their properties appreciate in value. They claim tax benefits for wear and tear, even if the property is rising in demand and generating higher rent. When they sell a property, they can use complex exchanges, such as 1031 exchanges, to defer taxes indefinitely. In many cases, taxes on property gains can be postponed for the investor's entire life. And when that person dies, the heirs may never pay taxes on those gains due to this step-up in basis rule, which resets the tax cost of inherited assets. Billions in appreciation can vanish from the tax system completely. Trusts are another essential mechanism. Wealthy families create long-term trusts to transfer assets to future generations with minimal tax exposure. These trusts are structured to grow tax-advantaged for decades. Wealth compounds tax-free. Families maintain control over the assets even as they move outside the taxable estate. Middle-class Americans lack the resources and legal teams to create such structures, but billionaires rely on them as a standard part of their strategy. Trusts are not loopholes. They are infrastructure. Philanthropy is often presented as the moral counterweight to vast wealth, but it is also a tax strategy. Billionaires donate portions of their wealth to foundations they control. These donations reduce taxable income dramatically. Meanwhile, the foundation often invests the donated money, and the billionaire retains influence over how funds are used. While many use this system to support real causes, it also allows immediate tax benefits for contributions that may not fully reach communities for years or decades. Philanthropy, for billionaires, is not just generosity. It is also financial engineering. Lobbying is the final pillar of the billionaire tax loop. The tax rules benefiting billionaires did not emerge by accident. They emerged through decades of strategic influence. Billionaires and corporations spend hundreds of millions shaping tax policy. They fund campaigns, support political action groups, and ensure that their preferred regulations remain in place. The average worker has no access to this level of influence. When billionaires want the tax code to preserve a specific benefit, they have the power and reach to protect it. This influence shapes the laws that shape the wealth that strengthens their influence in return, a perfect cycle. Understanding these mechanisms reveals why the tax burden feels so uneven. It's not because billionaires cheat. It's because the system defines wealth differently from work. Wage earners pay from their income. Asset owners pay only when they sell, and selling is optional. The structure itself is the advantage. And once the structure exists, the wealth at the top grows faster than any system can redistribute. The billionaire tax loop isn't a glitch. It is a machine. Every part, from borrowing to depreciation, from trusts to philanthropy, from capital gains rules to stepped-up basis, works together to ensure that wealth, once acquired, becomes nearly impossible to tax meaningfully. And as long as the system stays the same, middle-class Americans will continue shouldering the tax burden while billionaires expand their fortunes in ways ordinary people cannot match. Part of what makes the billionaire tax loop so powerful is how deeply integrated it is into the financial system itself. Once someone reaches a certain level of wealth, they don't simply participate in the economy. They move differently through it. Their money behaves differently. Their decisions create ripple effects instead of single outcomes. And their access to financial tools multiplies exponentially. In many ways, the tax advantages they enjoy are not separate from their wealth. They are a direct extension of it. Because once wealth grows large enough, it stops being money and becomes leverage. It becomes options. And in America, leverage creates tax freedom in ways that wage earners never experience. One of the clearest examples of this leverage is how billionaires interact with liquidity. For most people, getting money requires earning income. You work a job, get a paycheck, and pay taxes before you ever see a dollar. But for billionaires, liquidity is created through strategic borrowing. It isn't treated as income. It isn't taxed. It isn't penalized. It's simply capital generated from existing wealth. When billionaires borrow against stock portfolios, real estate holdings, or private company shares, they gain access to massive sums without triggering a taxable event. A billionaire might take a loan for $50 million at only 2% interest because banks trust the collateral so much they barely see the loan as risky. Meanwhile, the average American borrowing for a home, a car, or credit card debt faces interest rates several times higher. The wealthy borrow cheaply, spend freely, and repay strategically, allowing them to live a lifestyle that looks like income but isn't recognized as such by the government. This borrow against assets strategy also interacts with another piece of the tax code, the deductibility of interest in certain cases. If a billionaire uses loan proceeds for business investments, investment property upgrades, or expansion, portions of the interest may be tax deductible. This means even the cost of borrowing can shrink. While ordinary Americans pay high interest on mortgages, car loans, and credit cards with no special tax benefits, billionaires convert borrowing into yet another advantage. Their ability to use leverage at scale means they can expand their wealth, avoid taxable income, and use debt strategically in ways that make traditional taxation almost irrelevant to their lives. Another pillar of the billionaire tax loop lies in the concept of unrealized gains. This is a term many Americans hear but don't fully grasp. Unrealized gains are increases in value that exist only on paper. If you buy a home for $300,000 and its value rises to $500,000, you've gained $200,000 on paper. But unless you sell the home, you own nothing on that gain. Now scale that idea to billions. If a billionaire's stock portfolio grows by $5 billion in a year, that's $5 billion in wealth added without a single taxable event. Their net worth increases dramatically, but the tax code treats that increase as non-existent because no sale occurred. The result is that billionaires can see enormous jumps in fortune without any tax consequences at all, while regular workers are taxed on every paycheck regardless of whether their financial standing improves. This system becomes even more effective when combined with control-based ownership structures. Billionaires often hold their assets through family offices, trusts, partnerships, and corporate entities that separate ownership from the individual. These structures allow the wealthy to shield assets, limit tax exposure, protect holdings from creditors, and pass wealth between generations with minimal friction. Trusts, in particular, form a major part of multi-generational wealth planning. They allow families to control assets without triggering direct ownership taxation. They also enable wealth to grow in a protected environment where capital gains can accumulate without being taxed until distributions occur, if they occur at all. Many trusts are structured so wealth can grow for decades untouched. Family offices, the private financial firms billionaires run exclusively for their own money, play a huge role here as well. These offices hire teams of attorneys, tax strategists, wealth advisors, and investment analysts whose sole purpose is to minimize taxes and maximize growth. These are not accountants filling out forms once a year. These are full-scale financial organizations dedicated to engineering the most efficient tax positions possible. The average American cannot compete with this level of financial infrastructure. The playing field isn't just uneven. It's engineered for a specific result, keeping wealth concentrated. Another powerful mechanism billionaires use is equity compensation. Many billionaires grow their wealth by taking stock instead of pay. Because stock compensation isn't taxed as ordinary income until sold, it becomes a perfect tool for deferring taxes indefinitely. CEOs and founders collect millions of shares rather than millions of dollars, allowing them to accumulate vast wealth without the IRS touching it. Even when stock is eventually sold, it is taxed at capital gains rates, which are far lower than income tax rates. A billionaire paying 20% on gains through selective liquidation ends up with a significantly lower tax burden than a middle-class worker paying 22 or 24% on ordinary wages. Real estate adds another dimension of tax optimization. Through depreciation, the law allows wealthy investors to claim the value of their property is declining over time even when its market value is rising. Billionaires build entire real estate empires around this concept. They acquire properties, claim aggressive depreciation deductions, offset taxable income, and then refinance those properties for liquidity. Through refinancing, they borrow tax-free cash while holding onto the asset and continuing to reap tax benefits. When they eventually sell a property, they can use a 1031 exchange to transfer the gains into a new property, deferring taxes yet again. This cycle can continue for decades, allowing wealth to multiply tax-free while appearing compliant with every rule. The role of philanthropy in the billionaire tax loop is frequently misunderstood. While many billionaires donate out of genuine altruism, the tax structure surrounding philanthropy makes it an ideal vehicle for reducing taxable income. Donating appreciated assets to a foundation eliminates capital gains taxes entirely. The billionaire receives a tax deduction based on the asset's full market value, even though they never realized the gain. Their foundation then invests that asset, compounding it tax-free, while the billionaire often retains indirect control over how funds are used. The public sees generosity. The IRS sees compliance. The billionaire sees a win on both fronts: reduced taxes and enhanced reputation. Another overlooked aspect is loss harvesting. Billionaires don't just profit, they manage losses strategically. When markets dip, They sell underperforming assets to offset gains in other areas. This technique, called tax loss harvesting, allows them to reduce taxable income by recognizing losses that may only be temporary. They often repurchase similar assets shortly after through entities structured to avoid wash sale rules. To the IRS, it looks like a loss. To the billionaire, it's simply a repositioning that provides a tax advantage without altering their long-term investment strategy. Then comes estate planning, arguably the strongest shield in the billionaire tax loop. Through a combination of trusts, life insurance structures, valuation discounts, family limited partnerships, and step-up basis rules, billionaires transfer enormous fortunes to their heirs with minimal tax exposure. When a billionaire passes away, their heirs often receive assets at a new tax basis equal to the market value at the time of inheritance. This eliminates decades of untaxed growth. Billions in appreciation disappear from the tax system instantly. While middle-class families may struggle with estate taxes on modest assets, billionaires can transfer massive wealth pools with extraordinary efficiency. Even retirement accounts become part of the strategy. While ordinary Americans save modest amounts in 401(k)s and IRAs, billionaires use self-directed retirement accounts to shield investments in private companies, real estate, and startup equity. These accounts grow tax-deferred or tax-free. Some billionaires use Roth conversions to lock in tax-free growth for life, allowing fortunes to compound away from IRS reach. But perhaps the most important force behind the billionaire tax loop is influence. Billionaires don't just navigate the tax code, they help shape it. They fund lobbyists, political action committees, policy think tanks, and research groups that propose and advocate for tax rules favorable to wealthy individuals and corporations. When Congress debates tax reform, billionaire-backed organizations supply research, data, and suggested language. The tax code becomes a mosaic of provisions inserted by those who benefit from them most. Ordinary Americans follow the rules. Billionaires help write them. The result is not just inequality of wealth, but inequality of structure. The system treats wage earners as predictable taxpayers, collecting revenue directly from their labor. It treats the wealthy as investors whose activity must be encouraged and protected. These assumptions shape the entire philosophy of the tax system, creating a world where billionaires pay far less proportionally than the workers who sustain the economy. What takes the billionaire tax loop from a financial advantage to a structural force inside the American economy is the way it multiplies over time. Wealth is not static. It compounds. And when it compounds without tax friction, it accelerates in ways ordinary income never could. A worker earning $60,000 a year cannot escape taxation, cannot shield wages from withholding, and cannot convert earned income into tax-free borrowing. Their financial life is linear. Billionaires, by contrast, operate in exponential systems. A billionaire who grows their wealth by a modest 5% adds hundreds of millions of dollars in a single year, entirely untouched by tax until the moment they choose to realize gains, which may be never. This compounding without interruption is the silent engine behind the widening wealth gap in the United States, and it is one of the least understood aspects of the modern financial landscape. What makes the problem even more complex is that the tax system reinforces this compounding. By taxing wages and lightly taxing capital, it creates a built-in reward for shifting labor income into asset income. High net worth individuals do not merely benefit from low capital gains rates. They structure their entire financial lives around them. CEOs negotiate for equity packages instead of salary. Founders take little to no income while granting themselves voting control through share classes. Investors reinvest their gains into new ventures that also benefit from preferential tax rules. Every layer of the system encourages the same conclusion. Wealth grows faster than wages because the system wants it to. Another dimension is the timing advantage. Regular Americans pay taxes continuously, weekly, bi-weekly, or monthly. Billionaires, on the other hand, choose when to be taxed. They pick the moment of realization. They wait for the optimal year, the optimal quarter, the optimal administration, or the optimal price. Some wait a lifetime. Some never sell at all. And when they do sell, they offset gains through loss harvesting, charitable contributions, or strategic basis adjustments. Timing is power, and billionaires use it with precision. When taxation becomes optional, it becomes negligible. One of the most misunderstood aspects of the billionaire tax loop is how deeply it influences corporate decision-making. When tax structures favor capital over labor, corporations gravitate toward strategies that increase stock value rather than wages. Share buybacks become more attractive than employee raises. Capital expansion becomes more attractive than expanding payroll. Shareholders often benefit far more from these decisions than workers do. This dynamic contributes to a labor market where productivity and profits rise, but wage growth remains stagnant. The tax code incentivizes this imbalance by rewarding investment returns while taxing labor returns aggressively. Billionaires, as majority shareholders, profit enormously from these dynamics, creating yet another loop where wealth begets more wealth. International structures also play a role. Wealthy Americans often use offshore entities, not for illegal evasion, but for legal optimization. Multinational corporations shift profits to low-tax jurisdictions through transfer pricing, intellectual property arrangements, or jurisdictional arbitrage. These structures reduce global tax exposure and protect assets from domestic risks. While everyday Americans file straightforward tax returns, billionaires manage global webs of corporations, partnerships, and trusts designed to minimize exposure on every front. Their wealth moves across borders more freely than wages ever could. And because international tax rules are extraordinarily complex, they often benefit those who can afford sophisticated planning rather than those who comply in the simplest form. Another critical element is the political insulation that billionaire wealth creates. When individuals reach extreme levels of wealth, they gain influence that protects the system benefiting them. Politicians who consider closing billionaire loopholes often face political pressure, campaign funding threats, or lobbying campaigns designed to shape public opinion. Proposals to tax unrealized gains, eliminate step-up basis, or impose wealth taxes frequently die before reaching legislative debate. Even modest reforms like adjusting carried interest rules face fierce resistance. This political resistance is not random. It is the result of financial power shaping the rules that govern financial power. Billionaires do not just operate inside the system. They influence the system to keep it operating in their favor. What makes this structure so difficult to change is the narrative that surrounds it. Billionaires are often framed as job creators, innovators, or essential drivers of economic growth. Some are, some aren't. But the broader truth is that the tax system treats wealth creation as inherently beneficial and labor compensation as inherently taxable. This philosophical foundation dates back decades, reinforced by policy, academic theory, and political messaging. Changing the billionaire tax loop requires more than rewriting a rule. It requires rewriting the philosophy that built the rule in the first place. And because that philosophy is rooted in the belief that capital must be protected and incentivized, reform becomes extraordinarily difficult. It is also important to understand how subtle the wealth transition mechanisms are. When billionaires pass their wealth to heirs, it is not simply inheritance. It is engineered inheritance. Trusts remove assets from taxable estates. Valuation discounts reduce the assessed value of transferred interests. Step-up basis erases decades of gains. Life insurance structures deliver tax-free wealth transfer. And family partnerships allow control to remain centralized. Entire industries exist solely to ensure that billionaire fortunes remain intact for generations. Meanwhile, ordinary families face estate taxes on far smaller sums or lose significant portions of wealth due to medical bills, long-term care, or market instability. The inequality is not just financial. It is structural, embedded into multiple layers of the tax system. The philanthropic side of the loop further complicates public understanding. When billionaires donate billions to foundations, the public sees generosity. But the tax benefits are immediate and substantial. Donating appreciated stock wipes out capital gains tax and provides a deduction based on the full market value. The foundation then invests the assets tax-free, compounding indefinitely. Some foundations spend only a small percentage of their assets annually, allowing them to grow as effectively as private investment vehicles. Meanwhile, the billionaire who created the foundation gains public goodwill, influence, and long-term control over philanthropic direction. This creates a cycle where philanthropy becomes both a public benefit and a private tax strategy, blurring the line between generosity and optimization. Another overlooked dynamic is how billionaires use political rhetoric around small government to protect their tax advantages. Calls to reduce government spending rarely focus on restructuring the tax code. Instead, they target social programs, public infrastructure, or middle-class benefits. By framing taxation as a burden rather than a civic responsibility, billionaires shape public opinion in ways that keep their own tax advantages intact. The conversation never reaches a deeper question. Why are workers taxed at high rates while billionaires structure their wealth to avoid taxation almost entirely? The narrative focuses on who receives benefits rather than who avoids obligations. This redirection protects the system by shifting attention away from the top. The impact of the billionaire tax loop is not just visible in wealth concentration. It is visible in how opportunity is distributed. When tax burdens fall heavily on workers, public investments that could benefit society, education, healthcare, infrastructure, affordable housing, become harder to fund. The middle class carries the weight of financing the country while billionaire wealth compounds in private structures. The imbalance creates long-term economic instability because the economic engine of the country, the working and middle class, faces increasing strain while resources accumulate in places that are effectively shielded from redistribution. The result is an economy where upward mobility slows, wealth gaps widen, and the system feels rigged not because people misunderstand it, but because they understand it perfectly. What makes the billionaire tax loop particularly resilient is the sophistication behind it. Every component, unrealized gains, borrowing strategies, depreciation, trusts, corporate structuring, charitable planning, lobbying, and political framing, works together to create a cohesive system. It is not one loophole, but a network of advantages. Even if one loophole were closed, the system would still function because the structure is layered. Wealth is protected by design, not by accident. There is no single fix because there is no single problem. The entire framework supports the outcome. Reforming this system would require rethinking how America defines income, wealth, taxation, and civic responsibility. It would require treating wealth growth the same way labor income is treated. It would require addressing the political influence that protects the system. It would require shifting the philosophy from rewarding wealth to balancing the needs of the broader society. But these reforms face enormous resistance because they challenge the incentives of the most influential people in the country. Billionaires are unlikely to voluntarily support reforms that increase their tax burden. Politicians who depend on their donations hesitate to push change. And voters are often divided by messaging designed to protect the status quo. The question that remains is whether the system can continue operating this way indefinitely. Historically, when wealth concentration reaches extreme levels, societies experience political pushback. Tax systems evolve. Economic structures shift. The U.S. has experienced this before, in the early 1900s during the rise of industrial tycoons, and again in the mid-1900s when inequality reached unsustainable levels. Whether America is reaching another such moment remains to be seen. But the billionaire tax loop will remain at the center of that conversation because it is not just a financial mechanism, it is a defining feature of modern American inequality. The reality is that most billionaires will continue paying far lower tax percentages than ordinary workers unless the underlying philosophy changes. As long as wealth is rewarded with lighter tax treatment, as long as capital gains remain protected, as long as unrealized gains remain untaxed, and as long as borrowing allows billionaires to avoid converting wealth into taxable income, the loop will remain intact. This is not pessimism, it is mechanics. Wealth moves through the system differently than wages, and unless the system is redesigned, wealth will continue to rise faster than it can be taxed. This is the world the billionaire tax loop has created, one where wealth grows in private while obligations fall on public shoulders, one where the richest individuals legally contribute far less proportionally than the workers who keep America functioning, and one where the tax code has become not just a set of rules, but a map showing exactly where the wealthiest can walk without ever touching the ground. Understanding this loop isn't just about economics. It's about understanding the structure of power in America.